Some investors try to protect themselves from losing money, while others seek to grow their wealth as fast as possible. Wealth accumulators fall into the latter group. They understand that accumulating wealth is a marathon, not a sprint. They know that protecting your capital isn't the best way to grow it, so they don't try to avoid losing money by investing in boring, slow-growing assets like government bonds or cash. Instead, they push their capital into whatever opportunities they believe will provide the highest growth, even if it means taking on higher levels of risk. In this video, we'll look at the investment playbook of these bold wealth accumulators to see how they make their millions and sometimes billions. We'll also explain how you can incorporate some of their habits into your own portfolio to get better returns. First, let's talk about what the typical portfolio of a wealth accumulator looks like. It tilts heavily towards equities. Unlike many investors, wealth accumulators don't shy away from volatility. They know that short-term setbacks are inevitable and that a well-built portfolio can withstand market fluctuations. That's why they don't just invest in safe assets like bonds or cash, which offer low returns and can't keep up with inflation over the long term. Instead, wealth accumulators look for investments with high growth potential, whether that's in stocks, private deals, or alternative assets like hedge funds, venture capital, or private equity. Take Warren Buffett, for example. He built his fortune by investing in companies he believed had strong growth potential, even if they were considered risky by other investors. Similarly, many hedge fund managers take on a lot of debt to invest in a small number of high-growth companies, betting big on their potential to deliver outsized returns. Of course, this strategy isn't without its risks. There are plenty of examples of investors who have lost big chunks of money by betting on risky investments that didn't pan out. But that doesn't deter wealth accumulators. They understand that accepting short-term losses is part of the process of achieving long-term success. In fact, they embrace volatility as a way to find great deals on investments that have been beaten up by the market. Take Ray Dalio, for example. He is one of the most successful investors of all time, and he attributes much of his success to his willingness to go against the grain. When everyone else was buying, he would sell, and when everyone else was selling, he would buy. This approach allowed him to buy low and sell high, generating massive returns for his investors. So if you want to follow the playbook of wealth accumulators, you need to be willing to embrace volatility and accept short-term setbacks as part of the journey. Don't be afraid to go against the grain and make bold moves when others are being cautious. You may lose money in the short term, but if you stay disciplined and stick to your plan, you should be able to generate bigger returns over the long term. Now, let's talk about another aspect of the playbook, cutting your losses. Wealth accumulators know that not every investment will go according to plan, and that some will inevitably turn into losers. That's why they set clear criteria for when to cut their losses and stick to them no matter what. They won't hold on to a losing investment just because they've already invested a lot of money or time into it. Instead, they'll cut their losses and move on to the next opportunity. This approach allows them to focus on their winners and let them run, while also minimizing the damage from their losers. Take Charlie Munger, for example. He's been investing for decades and has seen his fair share of losers. But he knows that cutting losses is key to staying profitable over the long term. He once said, "If you've got an investment that's gone down 25%, when are you going to get out? When it's down 90%. This approach may seem counterintuitive, but it makes sense when you think about it. Why hold on to a losing investment just because you've already lost a lot of money? It's much better to cut your losses and reinvest that money into new opportunities. Of course, cutting your losses doesn't mean that you should sell as soon as you see a dip in the market. You still need to have a long-term perspective and be willing to weather short-term storms. But it does mean that you shouldn't be afraid to sell an investment if it's not performing well and there is no clear path to recovery. If you want to follow the playbook of wealth accumulators, you need to be willing to cut your losses and move on. Don't let your emotions get the better of you and cloud your judgment. Stick to your plan and be willing to sell if the investment isn't meeting your expectations. By doing so, you'll be able to focus on your winners and minimize the damage from your losers, setting yourself up for long-term success. Next, let's discuss rebalancing. Wealth accumulators know that asset classes perform differently at different times, and that it's important to reallocate your money to take advantage of changing market conditions. For example, during the pandemic, they saw the stock market crash, but also huge growth in tech stocks. They took this opportunity to sell some of their holdings in beaten-down sectors and invest in those that were performing well. By doing so, they were able to take advantage of the market volatility and generate higher returns. Now, rebalancing doesn't mean that you should constantly be buying and selling investments. It's not a short-term strategy designed to capitalize on daily market fluctuations. Rather, it's a long-term approach to managing your portfolio and making sure that you're always positioned to take advantage of changing market conditions. Take Ray Dalio's all-weather portfolio, for example. It's designed to perform well in all market conditions by diversifying across different asset classes and geographies. The portfolio is regularly rebalanced to maintain the desired asset allocation and take advantage of new opportunities as they arise. This approach has allowed Dalio to generate impressive returns over the years and has made him one of the most successful investors of all time. If you want to follow the playbook of wealth accumulators, you need to be willing to rebalance your portfolio regularly. Don't be afraid to sell investments that are no longer in line with your goals and invest in those that have the potential to grow your wealth. By doing so, you'll be able to adapt to changing market conditions and position yourself to take advantage of new opportunities. Remember, rebalancing isn't a short-term strategy. It's a long-term approach to managing your portfolio and ensuring that you're always positioned to grow your wealth. Finally, let's talk about research. Wealth accumulators know that investing is a competitive business and that it's important to constantly be on the lookout for new opportunities. They spend countless hours researching companies, markets, and trends to identify areas where they can generate alpha, which is a fancy way of saying they look for investments that have the potential to outperform the market. They don't just rely on gut instinct or the advice of others. They dig deep into the data and use their own analysis to make informed investment decisions. Take Warren Buffett, for example. He spends dozens of hours every day reading through financial statements, talking to industry experts, and analyzing economic data. He's constantly on the lookout for new investment opportunities, and he's willing to wait patiently until he finds the right deal. Similarly, many hedge fund managers have teams of analysts working full-time to research potential investments. They use advanced tools and techniques to analyze vast amounts of data and identify patterns that can help them generate alpha. Research is essential to the playbook of wealth accumulators because it allows them to find investments that others have missed. It helps them to avoid common mistakes and to make informed decisions based on facts and data rather than emotions or hype. If you want to follow the playbook of wealth accumulators, you need to be willing to put in the work to research your investments. Do you just buy into something because it's popular or because you think it will make you a quick buck? Take the time to understand the fundamentals of the investment and to see if it is a good fit for your portfolio. By doing so, you will be able to find hidden gems that others have missed and generate higher returns over the long term. Building wealth takes time and discipline. But by following the playbook of wealth accumulators, you can set yourself up for success. Embrace volatility and accept short-term setbacks as part of the journey. Cut your losses and move on from investments that aren't working out. Rebalance your portfolio regularly to take advantage of changing market conditions and always be on the lookout for new opportunities through research. If you're willing to follow these steps, you can increase your chances of building wealth over the long term. But remember, there's no guaranteed path to success in investing. You need to be willing to take risks and to learn from your mistakes along the way. That's all for now. We hope you enjoyed this video and learned something new. If you'd like to learn more about the investing playbook, please contact us. Thanks for watching.